Thank you for being here.
morning.
I hope you guys find the information very helpful. Wait. Okay, so today I wanted to talk about two different loan programs that we have. The first one is gonna be the 1099, and then the second one is California Control, which I think everybody has heard about it. It's been all over news and stuff, so. Okay, the 1099 program is intended for people that get paid by 1099s rather than W-2s. You can use 1 year of 1099 to be able to do either a purchase or a refinance transaction. This is only for primary residents only. You can use, or the lender will use up to 90% of the 1099 income to qualify the borrower. They have a 10% expense ratio. The only thing that they do require, whether it's a refinance or a purchase, is that the company or the employer that they get the 1099 it can only be one employer. It can be multiple employers.
So like if they work for construction and they have different jobs, they can use all the 1099s, is that what you're saying?
Yeah, it
Okay.
can only be one, and they will provide, or they will ask us for a confirmation that, there's only one employer that will either ask for 2 months bank statements to show the deposits or cancel checks to show that they're coming from one source only.
I have a question about that. I'm sorry to
Yes.
interrupt.
No,
Like, for example, if it's like real estate, because we're independent contractors, does that mean like you have to be at one brokerage for a year or like?
well, I mean, if you change brokerage, then that's a little bit different, but then that would be okay. It just, you
Okay.
couldn't work for like 3 different, I think for realtors, it wouldn't really apply. It's more for other, with other people like contractors that work for different companies and stuff like that. So it would be okay.
Okay, so
Yeah.
real estate would be okay.
Yeah.
Okay,
Yeah, no,
thank
definitely.
you.
Okay, primary residence, they can go up to $3 million on the loan amount, and it's for single family residence, units, townhomes, condos, and HUDs. With the purchases, they do require anywhere from 3 to 6 months reserves, depending on the loan scenario. The second one is for refinance transactions. They can go up to 75% if it's a cash out transaction. And that's the same thing again, this is only for primary residents, and they will go up to $3 million. The good thing about the refinance transactions, one thing that I noticed that it has helped a lot of people, that they can use the cash out that they're getting as reserves. That saves a lot, sometimes it saves the deal, if I'm honest, so that's a big help right there with it. The rates for this particular programs, they just depend on the scenario, they can start in the mid 7s. So that's the starting point, and then they can go up to, depending on the scenario. And this is for both, it's for a 30-year fixed loan. So then the second program that we're gonna be talking about is California Free for All Share Appreciation with CalHalpa. These are the main things that they do require for anybody that's looking to get pre-approved or go through this program. They will be doing a 20% assistance or up to $150,000, whichever is the lesser of the two. All of the borrowers have to be first-time home buyers. When they say first-time home buyers, they cannot have owned a home within the last 3 years. And one of them must be a first-generation home buyer. So with that, they cannot have been on a home within the last 7 years or been on title of a home.
And that even means the parents, they cannot have
yeah.
even owned a home.
Yeah, the parents cannot have owned a home
Currently,
yeah.
when you take on title.
But I mean, doesn't mean that all of the borrowers, or at least one of them has to meet this guideline for, for them to be able to go,
Okay.
or for them to be able to do this program. They must be a current California residents, and there is income limits for this particular loan. They do have to be a U.S. citizen or qualified residents, and they do have to take a homeowners education class. From what I've seen, it's about an hour class, and just depending on where they go, it could be a free class or it could be up to, I believe, $100 from what I've seen. And a lot of times that's just available online, so it's easier, more convenient for everybody to do those. The property does have to be owner occupied. All of the borrowers and co-borrowers have to occupy the property. There's no non-occupant co-borrowers, that's not an option for this particular program. And everybody does have to, or not everybody, but they have to move into the property within 60 days after they close. The credit scores, the minimum credit score for this program, they do need 680, and the max debt to income ratio, they can go up to 45. If they have 700 or higher FICO score, they may be eligible to go up to 50% on their debt to income ratio. The houses that qualify for this program are single family residents, condos, HUDs that are Fannie Mae eligible, and manufactured homes. The manufactured homes they have to own the land as well.
Permanent foundation.
Thank you, Lala. They do have to be also in a permanent foundation, and it cannot be a single wide home. And these are the income limits for Riverside and San Bernardino County and Los Angeles County and Orange County. Just kind of did the ones that are within our area or surrounding us so we can get an idea of what the income limits are for this particular program. And right here are some of the events that can cause repayment of the principal and the appreciation. If there's any type of transfer of title, if they sell the property, or if they pay off the first loan. If they pay off the second loan, they're still responsible for, giving the appreciation back as well as part of the loan. So, or if there's a formal filing of recording of notice of default. The borrowers can refinance. If they can refinance and subordinate, the second doesn't have to be paid back only if they do a rate and term transaction. That's a one-time thing. If the second time, if they do refinance, it would have to be paid back as well. Okay, and then this is, let me see if I can do a little bit here. And this is just a little example of, how they consider or how the funds are paid back. And it starts with, if they buy a house for $500,000, the DPA program will give them $100,000, and their first mortgage will be $400,000. 5 years later, if they decide to refinance the property and their home value has gone up, the appreciation, a home price appreciation amount would be $140,000. So from that $140,000, they would take 20% back, and it would be $28,000 of the share appreciation that they would give apart from the funds that they had borrowed as well. So the total amount that they would be giving back, it would be $128,000. And then the second scenario is if they were to sell the house up, the first mortgage balance would be $370 because they have paid it down. But the value is the same, so it would be the same amount that they would be given back, the loan amount plus the appreciation, 20% of the appreciation amount.
Can I ask you real quickly?
Yes.
Okay, so let me make sure I understand. So if they bought it for 500 and they got 100,000, how did we come up with 112? Is it because it's 20%?
20% of
20% of the
Yeah.
value.
So they're not getting back the 20% that they gave them, they're giving back 20% of the new value.
Of the new value, yes.
Okay,
Yes.
okay. Plus
Plus the 100,000 that they initially bought.
the,
The 112 would be what the homeowner would keep as equity.
It's like an 80-20. Yeah.
I'm kind of curious what's the leftover. So you give them back what they give you, and what does the homeowner get?
So, they would end up with 112,000 of equity,
Well, okay, but I'm looking like more on the sales side.
So on the sales side, they, let's say with the 5 years, they estimate that the mortgage balance would be at 370. So it would be, if their loan amount was 400, that would be 30,000 already in equity that they paid off, plus their share appreciation, which is 112,000. So the borrower would get around 142 back.
Yeah, and I think the idea of this is that they're able to be a homeowner. So it's just building wealth as a homeowner. That's the whole idea of this program. It's not so much what I'm gonna get back in appreciation. Yeah, that is important, but what Cal Halco was sharing with us was it's more to get them into a house and allow them to the first generation of buyers to be a homeowner. Like that's the main purpose of Dream for All. Those that were not able to get any houses are now able to bring wealth into their generation, into their family as a homeowner. So the opportunity of being a homeowner is basically the benefit, the overall benefit, and of course the appreciation, whatever is there.
Yeah. And then apart from the California Dream, CalHalpa does have other programs where it's the My Home, where they'll give the borrower anywhere from 3 to 3.5% of the down payment. And they also have the SIP program, which would be considered a third loan, that it's anywhere from 2 to 3% that would help them with the closing cost. So there's always a lot of different options, not just the California for Dream Wall. There's also down payment assistance programs that, the borrowers would be able to qualify, because I know everybody wants to try to get for this one, but it's a lottery-based system that they're doing it this time around. So after the borrower has been pre-approved, the borrower gives them a pre-qualification letter, it's submitted, and if they get picked, they have up to 90 days to find a home.
Yeah. Can I just say a couple of things? So what I wanted to just share with this, because Sandra and I were working on this program, what CalHalpa is trying to do is allow those that were not able to buy a home to buy a home. And so there is income limits in the county that they're going to buy the house in. The reason why they're bringing this program now is because they're urging the home buyer to pre-register for the voucher that they're going to get from the lender. Because at the end of April or the end of spring, they're thinking April, it could be pushed all the way to June. They're going to close the registration, and then they're going to do a random, they don't want to call it lottery, but it's going to be a random pick of those homeowners that pre-registered. So what happens is if we get all our buyers in right now, we get them pre-approved, pre-qualify, the lender stamps it, yes, you qualified based on those conditions, here's your voucher. They take that voucher, they pre-register on the system. Now they're entered into this random lottery that they're going to have at the end of April. If their name gets pulled, they have 90 days to go out and identify the property, and everybody's happy. If they don't get picked, the second option would be CalHalpa My Home. So we want to be able to give options to the home buyer that, yes, this program is available, but in the case that you don't get picked, there's other programs that are available because these funds are there all year round. So we want to give them, this is option A, this is like the best option possible, and this is option B. But it's very important that if we're talking to buyers at open houses or wherever we might be, is to set that urgency of pre-registering, because they are going to close it at the end of April. And basically it's allowing you to get into that lottery of 20% of your down payment, which has never been done. There is income limits, depending where you're going to buy, that's going to be the income limit that's going to apply in that county. So CalHalpa will be investigating the files, because everybody's like, well, how do you know that my parent doesn't own anything in the United States? They did make it clear that if we have any knowledge as a lender, or the buyer intentionally misrepresented that information, they will go after those people. So it's very important that if the buyer somehow identifies or kind of says, well, I know this, but I'm going to put that they don't have it, be careful, be cautioned, because they will be investigating those files. And if they find out they misrepresented that their parents or foster parents, do have a house, they are on title for a mortgage or for another property in the United States, they will go after those people. So it's very important that we pre-screen them. It's a great program for those that do qualify, that can take advantage of this. But we also want to give option B, which is My Home, which is also available all year round for that one. Yes, so that's what we're going to be explaining to the home buyers, and they will explain this through the 1-hour training that CalHalpa does require them to go through, so that they could pre-register this voucher. So, it's very important that we understand it, so that we're not misleading them with the information when we're talking to them. But we can educate ourselves and them, so that way, if it's not for them, that's fine, but we're able to explain it to them. So I hope I answered. Did that make sense, or do we understand? Okay. Yeah. Thank you, Sandra.
Thank you. And then that's it. Does anybody have any questions?
On the regular CalHalpa, they have to pay that back if they refi or if they sell.
Yes, correct. Yeah, they just have to pay back whatever they borrowed. whether it's just a second or a second.
The 2 to 3%, right, that they get.
Yeah, they have to pay, like, yeah, the second, and if they do a third, they also have to pay the third back as well.
Okay.
With, go ahead.
Oh, sorry, would you be able to send us this, presentation?
Yes, definitely, yeah, I can get your email.
You want me to just email?
Yeah.
Okay.
Yeah, no,
Thank
I'll send it to you. I wanted to mention with the CalHalpa, the FICO score that they can qualify for, it can be a little bit lower. I believe if they can go a minimum of 640. So, that's always another option too. If for whatever reason their credit score is not where it should be at.
Can I say something?
Yes, oh,
Okay, so I'm a loan officer here, we're part of the same team. And one thing that I really encourage you as a realtor, the minute you see that a client is interested in pursuing this particular program, tell them, make an appointment with a loan officer right away. Because this program is very unique in its own, especially this whole Dream for All, then you have the CalHalpa, ratios are different, the way they calculate the income is different for CalHalpa than a traditional loan. So if you start getting them, guiding them one way, it can be very confusing, and then they go out with the notion that, okay, I got it, I got my money for the down payment, let me start looking for a house. Tell them, go get qualified, because the funds are here, but they're gonna run out, and if you just wait and see and hope that happens, your name is not gonna be in there, and then, now you gotta remember also, CalHalpa itself, the department, because I've done quite a few CalHalpa loans, they don't have a traditional turn time. Let's say, for example, a lender, you submit your loan and you get it approved in 24, 48 hours. CalHalpa will say, today is 2-week turn time. Tomorrow is 3-day turn time. Okay, next week, okay, now it's a month turn time. Depending on the volume of stuff that they get, that's the turn time. So there's so many factors that unless you're, as loan officers, we educate ourselves on these programs all day long, because in lending, the guidelines change a lot, very fast. So you wanna say, hey, here's a program, this is really good for you. However, I urge you to meet with a loan officer, get all the answers, get pre-qualified, this is the way you wanna go. Don't wait until you find the house that you like. Just my little.
thank you for the information.
Yes.
Yeah.
Oh, very helpful, thank you, ladies. Okay, and then Sylvia is gonna be hosting a
Yes.
class, a CalHalpa class. If you guys have any buyers that want to get a little bit more familiar with it or looking to get pre-qualified, she will be hosting the class on February 27th in her Legacy First Escrow office between 6 and 8 o'clock. So if you guys know of any, agents that want more information, or if you guys have any buyers, she can definitely help you with that.
Yes, we're gonna go into detail that day, we're gonna talk to buyers and explain to them, what do you need, what does it look like, why is it important that you get qualified, all that good stuff, and these buyers need to know all this so that we can help them and guide them into a home. So I hope to see you all there with your buyers.
So you guys work with that program?
Yes,
Yes.
So
yes.
there's like some lenders that I've been working with, they're like, oh, I don't do that, like they don't work with that.
Because they don't wanna waste their time on it.
They are
Yeah.
very,
Yeah. That's what it
yes,
is.
they're
Yeah.
hard because they're not your traditional. So we've gotten certified through CalHalpa, where I actually went into their class and they gave a full presentation on using those, and even how to calculate their income, which is very different than your FHA or your conventional. And you wouldn't know that, you know what I mean? Because unless you take a full class, you're like, oh, this, and then I've submitted quite a few loans. So our company is approved
Okay,
to do all these down payment assistance programs.
okay.
And that's what we're gonna have, and we have quite a few flyers. Pass them around, send them to your clients.
Okay.
Those that are on the fence are like, well, let me wait till I save my money.
Yeah.
Do it now, because these programs will disappear.
Okay,
Yeah.
good to know, thank you.
Yeah. And the idea, what they said was, I guess the phase 1, which was the Dream for All, that kind of turned everybody off. They're like, you couldn't even get your app fast enough when the money was gone. So they learned from that, like we all learned from our mistakes, right? So CalHalpa learned that we actually have a contact for CalHalpa directly in Sacramento, just for, if there is that one particular app that we're like, oh my God, can we get this through? We do have a direct contact. I just want you guys to know that. I can't give it out, but we do. To answer your question, it is a conventional loan. But with this phase 2, they learn, so that's why they're saying, get your buyers pre-registered. So it's not like, let me get into escrow, and then by the time you need the funds were gone, right? That's what happened last time. So now they're like, okay, get everybody registered, those that do qualify, those that are open for, it's right, it's a fit for them. And then if they get picked, once they're registered, they went through the whole training, they get picked, then now they can go. But that's amazing. Like, who's gonna get 150,000, you get a house. So it's a great opportunity for the right buyer, and what happened last time was they didn't really spread it out evenly throughout the county. So they did assure us that they did want to make it more feasible. The whole intention of this is to build first generational wealth, like we said earlier, and that's why now they came up with a little bit different guidelines, and they made it specifically for first generational first time buyers. One of them had to do it because that is the purpose and intention. And so when we're talking to our buyers or our clients, we can explain, to them about this program, because if we understand the purpose and the intention of this program, we'll know if it's a fit for them or not. And so now they said that they were going to try to make it more fair and evenly throughout the counties, because I think it was like 33% low income wealth was like for the Hispanics, and then the other was white for non-Hispanic. So they saw like there was a big spread, in the diagram that they showed us. So so it's a great program for the right person, but we have to get them pre-registered, otherwise it's just going to be a dream.
Yeah.
It's going to stay as a dream. The dream will be a dream.
And just one more, like, if an immigrant, if they, have support out of country that maybe on the outside, they check that? Or
It's only in the United States. They did ask that question. It's only in the United States, and it has to be if they currently, and if say their parent passed away, the question would be, when they passed away, were they on title at that particular time?
Wow.
Yeah, so, there's specifics, but when, if you have a buyer that we have certain questions like that, once we can pick up the phone or email our direct contact, say, hey, is this gonna work for you guys? Because at the end of the day, the conventional lender is gonna write to CalHAF or to the state guidelines, because they're the ones that are gonna be funding it. So.
And I don't know if I missed, but does it have like a minimum income that they have to make the family?
Not minimum, but they have a
Income
max.
limits, yeah.
They can't make too much money.
Okay, but what's the,
Just enough to qualify.
Yeah,
So
well,
their ratio, so they can, you know what I mean? So they can make 40,000 a year, but they have to be able to qualify for the
Okay.
payments. You know what I
Okay.
mean? So it's the max, how much they can.
yeah, the max gross income limit gross on, for that household was 149 for San Bernardino and Riverside. And that has to be qualified wherever they're purchasing. So say you're in Orange County, but you're gonna purchase in San Bernardino, that income limit's gonna be 149 total. And then yes, you do have to qualify, like Sylvia said, 45% of your debt to income.
Okay.
So, and like Sylvia said and Sandra, they're here. If you guys have any questions, direct them to them, and they're the ones that will send it to the lender. Yes.
I have a question because you're so knowledgeable about it all. Well, all of you are. If both parents have passed, can they still qualify?
The question's gonna be when they pass, were they on title?
Are they
The
homeowners?
child or the home?
The parents, okay, the child that is the first generation or first time home buyer, if their parents passed away and they were on title when they passed away on the house, on the property, then, they won't qualify.
I guess to answer your question,
So if the parents are on
the
title.
key
Yeah.
is 7 years, remember,
Yeah,
7 years.
7 years.
So for example, my parents
Oh.
passed away 10 years ago, and they were homeowners then, but that was 10 years ago. So if within the last 7 years,
Oh, if it's over 7 years, then
Mhm.
they can qualify.
Well, yeah, I understand. So it's
Yeah.
7 years that they're a first time home buyer, but the parents, if the parents were on title currently, it's like now. So the question was, how long, can my parents have been on title? The question is, if they're currently now. The question was now.
Mhm.
So if they just passed away, we'll say, I'm saying within the year,
and they were
They might not
homeowners then
then,
they're not first
Right.
generation.
yeah.
Okay.
And once again, if we get into that fine line, like, well, they passed away 6 months ago or something, once again, we'll call HALFA. They passed away in 7 years. Is this an exception you guys will look at?
Okay.
Because that's what she said, the lady from Sacramento, she gave everybody a training, and it was the wording she used was now, presently. If they're on title or on a mortgage or co-signed for someone else, that was the verbiage they used.
Okay.
Yeah.
It's because I have a friend and his parents passed away like over 20 years ago, both of them.
Oh, okay.
So he should be okay, right?
Yeah, it should be fine, yeah.
Okay.
Yeah.
Okay.
Yeah, because it's not now, right? It's 20 years ago, yeah.
Okay.
Because I think that they're afraid that people are gonna try to, they're not afraid, they know people will try to,
Take advantage.
right, because it's a good program for the right person, but it's just a matter of getting it to the right people. The people that don't have anything and wanna build that wealth.
Okay.
Yeah.
Thank you.
Yeah.
Thank you.
Anybody else have any
So-
feedback, any shares?
So the only downside is, how many people are gonna win the
Uh,
2,000?
Yeah, they estimate about 1,800 to 2,000,
So
yeah,
that's not a lot.
yeah.
For the entire California.
Right.
Well, right, and that's why we wanna tell people about this, because people are excited about it, but once again, if it's not for them, there's other programs, like, it's not just that.
Yeah,
There's,
the regular co-op is good, but
Yeah.
it's not gonna eliminate their mortgage insurance like the dream.
but you know what, they were able to help, I think, what was it, 2,800 families last year. 2,800 families that got a home.
Great.
So even if it's one, you put one family into a house. So I always like to look at the, 2,800 families got a home that they wouldn't have if it wasn't for this program. And it's because the funds are not there. They only gave them so many. And I think they're testing it. They're gonna test it. There might be a phase 3. That might be a little bit different. So,
So the pre-approval has to be submitted by April, and then in May, they're gonna,
well, before, they're saying that it's gonna close out they use the word April or spring. So she said it could be as early as April, or it could be as late as June. But it's recommended that you get them pre-approved and qualified and pre-registered on that voucher before April.
okay, I heard different. I heard in
Yeah.
April, the pre-approvals have to be submitted into the system.
The voucher.
Yeah, so if they don't have that, then they
They're
don't
not-
get.
No, that's just for the Dream for All.
Yeah,
Dream
that's
for
But
all,
the regular
yes.
Cal
The
Hapa
Dream
is
for All.
available.
Yeah.
So far, it's still, I think they only shut it down for a short period of time during the pandemic.
Right, and then May, I thought that's when they were gonna start doing the lotteries.
they said they don't have a
But that can
specific
change.
date. Yeah.
See, that's the thing about Cal Hapa, that they can, that's why
As
I'd like to
early as-
explain, that's one thing I'm gonna emphasize on that meeting is, understand Cal Hapa has its own
It's a
timeline, and if they have 1 million applications, then they're not gonna give you an answer within a week. It might take a month, or it might take 3 weeks, so you can't wait for that time or that date,
Right.
because if they can't get to it soon enough, then you're out of luck.
Yeah, she said, April is the date, the target date that they're shooting for. There's no specific date, like on this date, when, we're registered to get any news when they do release that. But they use the word spring, and she said they purposely use spring so that they would give them that extra time if they needed it. So they, but yes, it could be as early as April that they shut it down. So that's why if you have someone, I would recommend to get them in as soon as possible so they can get that voucher and take the class. On the class too, we asked if everybody had to take the class, but she said no, just one person
Out of all the buyers.
out of all the buyers, yeah. And it's free too, because on some other ones I can be charged like $15, so it's free. They don't have to pay.
So Dream for All is a conventional loan. And what about My Home? Is that FHA or
It
conventional?
could be either one. It
Oh,
could be FHA or conventional.
thank you.
And there's other programs too that Sandra and Sylvia are gonna present, like there's veteran, CalHalpa programs that are really good. There's a lot out there. So slowly they're gonna start reading those programs and explaining them so that they're available to anybody that were out there. Like if your niche is gonna be this, you could focus on that and provide that. But we definitely have the lenders to support it. The veterans one is a good one.
Thank you, everybody.
Thank you, Sandra. We're like,